All right, welcome back to Two Stupid Guys Trade Stocks. I'm Vinny.
I'm Dylan.
And this week, Dylan's going to talk to us a little bit about preparing your portfolio for the incoming market correction. Yeah.
Yes, I have never done this before because I didn't know anything. Learned a lot in like the last 2 years. Before, I would just watch my account go down and cry. So basically, we are going to learn how to just mitigate the losses.
Yeah. I mean, it's important to mitigate those losses. Rule number one, right? Don't lose money.
Don't lose money.
Exactly. So, all right. Okay. I've heard of the strategy before. I've never used it myself, though.
Yeah, I figured that you'd like the little lizard because you love Warren Buffett and he owns Geico.
Yeah. So
basically, think of it this way. The whole plan is to utilize a rolling put on the SPY for a certain price per month to mitigate losses in what everyone would consider an irrational market.
Yeah.
Okay. This is kind of like an insurance policy. So I'm not using this to make a bunch of money because then that could also go the other way and you could just keep on rolling your puts out and the crash might not be for 3 years. We have no idea when it's going to be. And, people will say that they do, but I don't know. I won't get into that.
I know, right?
So this is just looking at since last June. We've had 3 decent corrections. You'll notice there are some other dips heading up above February, March, and April. But those are also bouncing off the 50 SMA. So it's more just normal ebb and flow of the market, whereas the other 3 went through them. You'll see 8.2%, 10.9%, and 6.3% corrections. One thing I want you to realize, and this is important, is that it takes much longer for stocks to go up than they go down. Okay, so that 8.2% took 5 days.
Yeah.
The 10.9 is 15 days, and that 6.3 is 15 days from peak to bottom. Good. Yeah. And then this is COVID. This is a 35.6% correction. And that took 24 days.
I stopped checking my portfolio at that time. I just closed the account.
I could not check it because I was margined.
Oh,
great time to be Dylan.
Yeah, that was great. I was heavily invested in Boeing at the time, so.
Oh, you know what? You might as well have been margined.
I
forgot you were invested in Boeing.
Yep.
So, essentially, what's a rolling option? It's just a fancy word for you're exiting your current position while entering a similar position, such as buying a put on the SPY at a certain strike price, expiring, let's just say October, ending that position, and then buying the same position, maybe even same strike price, maybe ending in January. Okay, so you're just rolling it over. We're going to go into the cost of how that works. So why would you actually do that? Why would you ever roll an option? That way you can extend the duration of the option as long as, and this is the most important part, your underlying thesis has not changed.
Mm-hmm. Yeah.
I thought you were going to say something.
No, I was thinking, like the whole idea with the rolling option too is you stay out of that state of decay time period too. So you always want to have that option so that there's at least 2 months or so left of time value.
Exactly. And interesting enough, I have examples at the end of within the theta decay period. And it's actually not what I thought. It was very interesting to do that. But the underlying thesis is the market is extended. We are due for a minor to major pullback. I think everyone can agree this is a very extended market. Trying to say it's going to happen next month, I think is ridiculous. I have no idea what's going to happen next month. But I think, Vinny, you would agree we're due for something.
Yes,
right?
Definitely.
Okay.
We've been due for something for like 3 years.
Yeah. So we're going to use some assumptions here because obviously these prices can very easily fluctuate, but a defined correction is usually between 10% and 20%. Mm-hmm. Those other ones were like 7, 8, and 11, and then COVID was 35. So we're just going to use 10%. Okay. So the current SPY is at 426.61, just closed at an all-time high. A lot of people thought it was going to die in June. Didn't happen.
Yeah, or April.
Or April. Well, Harry Dent predicts one a month. So
yeah, exactly.
But assuming a 10% correction, okay, so that's going to be our thesis. 10% correction, which would be a strike price of 384. So if you buy the July 30th expiration right now, and I put today's date so that you could see a month out versus 3 months out versus 5 months out. Okay, so just because this video is in June and you may see it in October, it doesn't matter. It's the proportions that matter. So July 30th expiration, $97 the cost of the put. September 30th, 421, November 19th, 710. Okay.
Wait, what is the strike price for this put?
384.
Okay. All right. Sorry.
Yeah. 10% down from the 426 high. Obviously, if we hit 450, 10% would be 45 instead. So the strike price is going to be different.
Yeah. Understood. All right.
So the assumptions, 10% correction. If it's more, then you make more. Actually, you make way more because it's an option. You make significantly more. If it's less, you make less. But essentially, if you buy multiple puts, you could just partial on your way down, yada, yada, yada. So July 30th expiration cost of put with 1 month before expiration, your at the money price is going to be $609. So 1 month before it expires, if the correction happens and it hits that 10% within said time frame, you would make approximately 6 times your money. September, which is a much safer one, in my opinion, and probably the one that I'm going to do. The at the money price, $12.25, you're looking at about 3 times your money. And then November 19th, 710. At the money price is going to be $16.40.
Nice.
Do one more click, and this is very important. So obviously, this is not a perfect scenario. The September, November returns would be higher because it's not including volatility. And when stuff is going downwards, it's crazy volatile. These numbers are predicted as of right now when the SPY is just slowly grinding up, seemingly forever.
Yeah.
I don't know. So the prices aren't the best representation, but you can see how much money you would actually make just by buying a couple put options 2 months out and just rolling them over, right? So let's say you buy them 3 months out. You could just lose probably about 25% of the cost and then buy another one 3 months out. Just keep on going and keep on going.
Exactly. Do you know what the spike in implied volatility will do for these returns, though?
It would lessen them, right?
Other way around.
It would increase them?
Yeah. Implied volatility is funny like that. Like it increases the price of the option as IV goes up.
Right, and no, increases the price of the option, but I thought decreases the price of the return.
No, since you're long the option, the increase in the price of the option would be good for you.
Yeah, you're right. Yeah, and which is also why buying the July 30th one is a little bit risky because let's say that we're in the middle of that correction, we're in the middle of the hump, then you're going to be really angry that you only have 30 days. Let's say it happens like July 20th. You got to hope something happens in that meantime because you could expire worthless. It's still a put option. So if it doesn't even hit your price and you try to hold out, you're screwed. So this gives you more time to have the thesis play out, and then you could just roll it every 3 months.
Yeah, that makes good sense. Yeah, I love it.
So then that's what I said above. This is just my personal opinion. Tons of people are calling for corrections within time limits. That usually means we're not going to have a correction for a little bit because the market's irrational. Vinny, have you ever sold? Actually, you might not have, but have you ever sold at the very low of a stock when you're watching it? You're a value investor, so I don't know if this applies to you.
Nah, I can't think of an example where I did that. I bought too early and I've sold too early for sure, but I can't think of a time where I sold right at the peak despair.
HOLX.
Well, no, it's actually gone down since then.
Oh, fair enough. Okay, fine.
Yeah, yeah.
Um,
I have mixed emotions on that one.
Fair enough. So there are instances where people will be like, I sold and it immediately goes up. You hear that all the time. It's definitely happened to me. And it's kind of a large psychology experiment, okay? Because there's hedge funds, there's bank, everyone's buying and looking at the same stock as it's happening. And there's a reason why your breaking point may be the very bottom of the stock. And that's not special, right? There's a reason why everyone seems to do that all the time.
Yeah,
So when people are starting to think this is topping, in my opinion, it means, okay, we're probably going to get another 20 points on the SPY. We might actually hit 450 because everyone is thinking it's going to happen. Cue this guy.
yeah, exactly. Yeah, Harry Dent. It makes me think of like the episode with on The Simpsons where like Homer predicts the end of the world based on like some crazy mathematical formula and like the Last Supper, and then he realizes like he drags everyone up to the mountaintop and like it doesn't happen, and then he realizes he was wrong in his math and like goes back and like redoes it, and like no one wants to go with him this time, but then he was actually right that time.
Great. Okay, so good example. Basically, Harry Dent will just predict. He's already been wrong, I think, 3 times this year. But eventually, you're going to be right. And people are just going to forget all the other 8 wrongs and be like, oh my gosh, this guy? Because that's the one that's going to go viral. It's going to, he was supposed to be December, April. I thought he had one for summer, but I could be wrong.
Yeah.
Eventually, you have to be right when you just predict so often.
Yeah.
You're going to get a correction eventually. You were supposed to lose, I think, 40% in April.
Yeah. 40% April. Yeah, that did not happen. Okay.
Yeah, I think he has one going for November now.
Perfect.
But like eventually it's going to be right. Like, I
mean, you have Burry saying too, the mother of all crashes. I mean, that's quite a inflammatory statement right there.
And Burry's a great example. He was right on the Big Short, and then he bought a bunch of nickels. And then he had like this whole water phase.
Yeah.
And those didn't pan out. He's a great investor, but no one's right every time.
Yeah. And it was like 2 years early on the housing thing too.
And he was 2 years early.
Yeah, exactly.
Well,
it was almost broken by the margin calls by the time that the bet came through to fruition,
Yeah, and if he had been right, like even 4 months prior, his gains, because he made a gross amount of money. He would have made like $40 billion had he been right, because he had more capital that he was risking.
True, very true.
That's it. That's the end of the slide.
Nice. Yeah, well, it's an interesting little option, like kind of play there for portfolio protection, I suppose. That'd be interesting. I'll have to, do a little more digging and think about doing it myself.
And it comes out, you end up losing about $100 a month that you have the option.
Yeah.
So if you're losing about $100 a month, but the market's going up and the majority of your portfolio is long, which everyone's is, then you're just losing $100 of your gains. And then when it crashes, you'll get a nice little 2-3 grand. Hey, you didn't lose everything. Here's 2-3 grand.
Well, I mean, think about it too, right? So it's 384 for the strike price, and that's a put contract, so that controls 100 shares at 384. So that's about a $38,000 hedge. So for $100 a month, you're hedging almost $40,000 worth of assets.
Yeah,
which is
I'm going to buy 2 or 3 puts.
Yeah,
and just roll them out.
Pretty reasonable. Yeah, be interested to see how this plays out for you. Like I said, I might do it myself. We'll take a little look at it.
All right. Have a good one, guys.
All right. Thanks for tuning in.